The thing that I've been obsessed with tracking down is where did all of these high net dollar retention rates go?
Where did the 130% net retention go? The missing 130s. But maybe we start with a story. Can you share maybe the favorite example that you have?
So this was the canary in the coal mine for me. So Workday, I think we all know who they are. They're the largest HCM provider, so HR software. It's how you figure out how many people work for your company. And they've also expanded into financial modules, including an ERP, billing system, etc. This is like a pretty straightforward SaaS play. And they, for a very long time, had reported net dollar retention rate and their gross retention rate, which is essentially like how often are customers renewing on a dollar denominated basis.
What was the historic net and gross retention rate of this business?
The gross is like almost never moved. It's always been 98%.
You either have to die or or you're gonna keep paying.
And then net dollar retention rate, like it was historically way above 120%.
Because they could sell you, like if you were on HCM, they could sell you the financial modules, or they could just raise price because you were locked in, or sell you maybe more user licenses, things like that.
You got it. They could sell you more licenses as you grow. And it was always done on like a per person basis. So if your company is growing, it's also going to go up with headcount growth over time. So the canary in the coal mine was last August. So about a year ago, the SEC sent Workday a letter and they read through their 10K. So each year you have to file this annual report. The 10Q is every quarter, 10K is once. And they noticed that something was off because Workday was referring to its net dollar retention rates in the MD&A. That's not a drug. It's management discussion and analysis.
It's a drug if you're CJ.
They weren't sharing the rates, Kyle. So the fine folks over at the SEC, they thought it might be something good to fix because like disclosures being like the whole point of doing an SEC filing. It's for the public good so you can be an informed investor.
So wait, so like they're basically like, we have very healthy net dollar retention rates, and the SEC's like, but what are they?
Yeah. And so they're like, dude, you got to like tell the people what it is if you're referring to it. And Workday actually wrote back. And what's cool about the SEC is you can find in print what the responses were if the SEC like says WTF. And so they said, upon further consideration and in light of our planned quantification of factors contributing to changes in subscription services revenue, we no longer intend to include disclosures related to net revenue retention rates in our SEC filings. Net, the SEC asked Workday to tell investors what their NDR was, and Workday says, nah, dog, I'm good. We'll give you the gross retention, which is roughly 98% and has always been 98%. We're going to call it a day after that.
They should really go in the newsletter writing misses. This is some writing skills. Upon further consideration and in light of our planned quantification of factors. Like, what is this language? This is worse than ChatGPT writing.
But it did the trick because SEC was like, okay, I guess. And they're not the outlier. This pattern is pervasive across the entire software index.
Workday, it still has great sticky customers from a gross revenue retention standpoint, and they want to keep sharing that with investors. But they used to be great at expanding customers. Now we have no idea. They're just not sharing the data, which I guess if I knew that was an option, it's a lot I would tell people. You're making it seem like this is not just Workday. This is a broader pattern.
It's not. And so as companies rode that seat-based expansion that we experienced during COVID and everybody was hiring, they were buying software, 120% or basically 20% embedded annual growth from the customers you already had, that became pretty normal. And I think in a lot of ways, Kyle, we didn't appreciate what we had until it was gone. So I'm going to get to some of the companies that stopped reporting, but I want to play a quick game with you as to the highest NDRs that you remember seeing.
Let's go for it.
What do you think Snowflake's highest was?
Oh, they were crazy high when they went public. It was like 175, I feel like.
Wow. 177 in their S1.
Yes. I didn't cheat. That was just my memory. Did they go public in like 2021? I feel like that was when I peaked. That was when all of SaaS peaked, myself included.
I think I peaked then too. I look back on that time frame. Twilio, early 2020.
They were good, but they were not that good. Maybe 130.
139, so almost 140. Once again, like as a publicly traded company, Kyle, you're saying I have 39% growth in the bag. That's a ton of growth.
What about Domo? Where were they?
Domo was over 150, I think, but they came back down to earth hard. And they're actually one of the folks that stopped reporting it.
These were some pretty high numbers that at the time just seemed like SaaS is a really great business model. Then seat expansion slowed down in dramatic fashion. What are some other examples here that had really, really high expansion?
GitLab IPO'd at 152%.
Although I think some of that was the price increases. They had like a massive price increase just before the IPO, but they staged it so that customers would have a stair step up in price like each year for 4 years.
And then my favorite one, just for their consistency, Datadog spent 14 straight quarters claiming, quote, above 130% in their 10Q.
That's a pretty impressive batting average.
And notice what I said there. I said above 130%. So that's not a specific number. And it's something we're going to get into in a little bit because there are different flavors of how you either disclose or don't disclose.
People assume there's a formula for it. Like if you were to Google how to calculate net dollar retention, you could get really clear advice.
I better come up, by the way, when you type that in. I've done way too much work on it.
I think Nickelback will come up instead of you. But we should say, like, this has never been a consistent metric within public companies.
Oh, no, it's not a gap metric. You're not required to disclose it, but based on the business model and who your comps are, it looks pretty funny if you don't include something that everybody else does. I thought it was the GOAT metric of the early 2020s because if you were in a room with any late stage investor or crossover investor, after asking about your growth rate, the second question was never about profitability. It was always, what is your net dollar retention rate?
There were examples like Figma. They got a lot of slack for how they calculated their net retention rates.
There are funny ways to calculate it where you can change what the look back period is or the size of the customer that you're going to include. So there are some companies out there like Snowflake, and they've always been consistent, but their look back period is not 12 months, it's 24 months. And in a usage-based or commitment-based model, you obviously have more time to ramp in 2 years versus 1 year, but at least they're only measuring the customers who were on board at that period 2 years ago. There are other companies that have played it fast and loose by saying, oh, it's net dollar retention rate, but we don't include any customers, say, below $5,000. And it's like, well, aren't 90% of your customers below $5,000? Isn't this basically just a metric of like big deals happen to stick around because they can't pull you out?
Wasn't there one that was like, this is the net retention rate, but excluding churn?
It was pretty bogus. And then they came back out and said, this is actually what we meant by it.
VCs will actually calculate this for every company so that there's consistency. But in the public market sense, like you're kind of doing some storytelling around this metric. Like this was never really a consistent gap metric. This was a way that companies could convince their investors that they were, building a healthy business.
Yeah, and the biggest crime that I've seen and actually committed myself, unknowingly at first at least, is using CAR. So you're using the expansion of whatever the exit deal value is. So say it's a 3-year deal that ramps at 100 to 200 to 300,000 in the third year, including that 300,000 as the actual expansion when you actually haven't billed or received that revenue or provided services for it. I'm saying that these companies should continue to give this metric, but I just want people to understand that it's never really been captured consistently, like in the vernacular.
Yeah. So basically discounting even the first year, you're kind of like baking in expansion when it's really just having a discount in year one.
Exactly.
When I went all in on my newsletter, Growth Unhinged, last year, I quickly decided it was time to make the switch to Beehive. I chose Beehive because they're serious about powering the internet's best newsletters. Beehive's all-in-one platform brings together newsletters, websites, and every tool you need to grow and earn. And they keep making it better. You can now launch, host, and monetize your podcast entirely on Beehive. You can host webinars on Beehive. And you can access Beehive through the new MCP. I just use Beehive's MCP in Claude Cowork to audit my site, prioritize SEO fixes, and analyze subscriber trends. It's my newest obsession. If you care about owning your audience, Beehive is a no-brainer. Try Beehive for free by going to beehive.com. That's BEEHIIV.com. Use Kyle30 for 30% off your first 3 months.